So we're now recording this webinar. It's Tuesday, December 4th, and it's 12 noon Central Time. Beautiful day outside. Beautiful weather here in Southeast Texas. Not sure how it is wherever you are, but I've got everybody on mute today so that we can just cover the information, and you can ask questions via email or call me later. We should be done in probably less than 15 minutes today, and I will send a link out to those that aren't able to make it, and we will also post it on our website so that others can view it in the future. I'm excited about what we're covering today. It's two very short topics, actually about both of them about investor behavior. The first topic is called the behavior gap, and I think that you'll find this topic to be very fascinating. And maybe you've heard of it before, but the behavior gap is the difference between the return we seek and the return we actually receive. So, for example, some people say, I'm only investing in the Standard & Poor's 500, and yet their actual return is less than the actual return of the Standard & Poor's 500. So this may seem counterintuitive, since it's in the best interest of every investor to maximize their return, but there's a lot of evidence to show that this behavior gap actually exists. And there are biological reasons as to why it naturally happens. So the evidence behind this starts with Dalbar. It's one of the most robust studies of the effect of investor behavior, and this company called Dalbar conducted this study. And they have found that the average investor return greatly underperforms the index they are trying to track. And this not only occurs over short periods of time, but also over periods of 20 and 30 years. So, for example, in their study, a 30-year period of time, an investor who's all in equity funds wanting to track the S&P 500 is actually returning over that 30-year period of time less than 4%, when the Standard & Poor's 500 returned a little bit more than 11%. That's a delta of over 7%. Over the 20-year period, not quite as bad, 5.9, so a little bit more than 5, 5.25, and the S&P 500 did just shy of 10%. So no matter what period of time we look at, investor performance, actual performance underperforms the index that they're trying to track. In addition to Dalbar, Vanguard conducted a 14-year study and found that investors underperformed not just the stock index, but the stock mutual funds that they are invested in by over 60%. So you're saying, how does that happen? Well, it's because they're getting in and out based on emotion. And so the fund that they're in over that 14-year period of time performed 173%, for example, but the average investor in that fund earned 110%. So 60% less. And also JP Morgan has found that the average investor historically has underperformed all asset classes and barely even beat inflation. The average investor there is the second to last one, slightly above inflation. So you might be asking, excuse me, I've got a tickle in my throat today. You might be asking, so how does this happen? One word, emotions. It is so much easier and biologically feels better to buy after witnessing gains and sell after experiencing losses. One reason we do this is because we often extrapolate our mood and expectation that we're having today into the future. Our emotional preferences are to do whatever we feel today. Gallup conducted a survey And they found that in April of 2009, the very bottom of the market of that financial crisis that we experienced, 34% of respondents said that savings accounts were the best long-term investments, while only 15% said stocks. The key here is that the question is long-term. People were projecting today, or April 2009, and how they were feeling and how the markets were behaving. They were projecting that feeling at that point in time well into the future, and it was a very costly decision. Now fast forward to April 2016. 7 years into a bull market with much higher stock prices, and investors felt more comfortable with stocks and much less in savings accounts than when stocks were much cheaper. So think about that for a second. Excuse me. If we're telling ourselves we like to buy low and sell high, but in April 2009, when everything was low, only 15% of investors were willing to say that stocks were the best place to be. The preference was savings accounts or CDs. So how do we minimize or eliminate this negative gap behavior? There are many things that we will do, but I have found that the following three are probably the most impactful. First, tune out the financial media. Their purpose is to get you to focus on the short term and make investing emotional. Both of those are not helpful to long-term investing. Second, we need to focus on your plan. The plan takes into account your goals, risk preferences, and it incorporates uncertainty of the markets. And finally, it's important to learn correct investment perceptions. There are a lot of preconceived notions that are wrong, and I can help with that. Each month, I put out messages and content to help you think correctly about what is going on, to keep emotions at bay and give us the best chance at reaching your goals. All right, that's it for topic number one, the behavior gap. Now we're moving into fluctuations in returns. I think you'll find this very informative and important as well, and actually enlightening for some of you. Most of us fear volatility, or at the very least, it isn't our friend. So our goal is to help investors see that volatility is very much our friend, so long as it is understood correctly. We know buying low gives us the potential to make good money over time. The key is that the only way to get low prices so that you can buy low is to experience volatility first. The challenge is that volatility scares most investors into selling, or at the very least, to become a deer in the headlights. So while most investors want to buy low, few are mentally and emotionally able to do so. Volatility presents the opportunity to buy low, which is what investors say they want to do. That doesn't mean it's easy. But the good news is that while we can't control the volatility of the market, we can control how much volatility we experience because it is largely subjective. Let me illustrate this. So Bob and Julie purchase the same security, and then they both sell it. Both have the same gain, but their experience was completely different because of how often they looked. Bob on the left, the chart on the left, he tracked his performance often. So this was his personal volatility with owning the security. Julie on the right, she didn't pay attention. She bought it and she sold it. So the only 2 points she was aware of was the buy price and the sell price. So we draw a line in between, and this was Julie's personal volatility. Volatility is largely a function of how often we look. Here's another illustration. This is perhaps one of the most powerful illustrations I've seen on this topic. You have two investments, A and B. Which one would you prefer? Now, this isn't a trick question, and you better have chosen investment B. Investment A goes up and down a lot and doesn't really make money, does it? You don't get paid for all the volatility. Investment B has some fluctuation, but a clear upward trend. No doubt you make a lot of money in B. Here is the catch. A and B are the same investment. They're both the Standard & Poor's 500. Here's the bigger catch. Chart A is simply a 9-month period of time within chart B. What we learn is that even great long-term investments could look downright awful over short periods of time. A didn't look very good over a nine-month period of time in this chart. And if you evaluate investments over short periods of time, in this case it was only 9 months, you may be influenced to sell what could have been a very profitable security. Now, market volatility is something that we can't control. And market volatility is not your volatility. Volatility is really a function of how often you look. And the second lesson we want to learn from this presentation today is we need to mention that your plan accounts for the volatility, and the risk assessments diversification is really all about volatility. Your plan accounts for those things. I trust that this has been helpful and eye-opening for you. Thank you for joining the webinar today. Please reach out to us if you'd like to discuss any of these concepts further. Our phone number is 281-990-8228, or you can find our email on the website. Have a great day and enjoy the beautiful weather. Bye-bye.